So good afternoon. Welcome to Tax System. Welcome to the latest in our series of webinars. Today we're going to be covering an update for property landlords. Just a bit of background. For those of you that don't know, some of you will be Taxis clients and will have relationships with accountants across the UK, some won't. Taxis are a network of accountants. We run out of about 380 locations and we look after around 80,000 mostly small business clients. So we're going to be talking today about our experiences in the landlord sector based on those clients and on behalf of our network around the UK. Because we've got a lot of content, technical content today, just a quick disclaimer that we have to provide. What we're covering today is really an overview of some fairly complex topics, and you'll see what I mean by that as we go through the content properly. It is just a snapshot. It is not designed to give you clear answers because it's very difficult, if not impossible, to do that. So please look at this as information rather than formal advice. We'll talk to you at the end about how you can get advice to cover these topics in a little bit more detail if you need to. But just bear that in mind as you go through. Just some quick introductions. So my name is Darren Moore. I'm Group Commercial Director. I'm going to be hosting today and supporting this bit at the start and a wrap up at the end as well. But the bulk of the content is by my two technical colleagues, and I'll just get them to introduce themselves.
Hi, I'm Claire Ellis and I'm the Tax Manager in the insourcing team.
Hi, my name is Gary Clark. I'm a Chartered Tax Advisor and I work in the technical department, so supporting franchisees with their technical matters. So I'll just quickly run through the things that we're going to be covering this afternoon. We've tried to keep it as topical as we can, and inevitably the first thing on the agenda is the impact of the coronavirus. We'll be looking at finance costs, in particular where we are now with tax relief on those finance costs. If you caught the news yesterday, there's a lot of talk about holidays at the moment, whether we'll be able to get away from this country during the summer or whether we're going to have to stay at home. And we've tried to cover the impacts of that on furnished holiday letting, so we're covering the pros and cons of that. Moving on to potentially incorporation, because that's a topic which has received a lot of coverage recently, especially with the impact of the loss of higher rate tax relief on interest. So Claire will be covering that, and then moving on to how you can plan, probably equally as well, with a small property portfolio with spouse transfers. I'll then be moving on to capital gains tax. Making tax digital is something which is on the horizon as well. 2023, but that's soon going to come around, so we'll be looking at making preparations for that. And then we're going to wrap up with some questions and answers. We'll see what questions have come through during the webinar and try and address some of those at the end if we've got time. I'm sure we will. Okay, so I just want to run through a few of the points that we picked up recently about the impact of the coronavirus. What we'll see is that where potentially you've got tenants that haven't paid, there's a 6-month notice period, except for in the most serious cases. And there's also a ban on evictions from properties until the 31st of March. Now, as we move towards, that's in Northern Ireland and Scotland, as we move towards the 31st of March, we may see that those time limits are extended. So keep a close eye on what happens. Court orders can proceed after the 30th of September of last year, but they will be prioritised according to the severity of the case. Landlords with mortgages can still seek to apply for a payment holiday of up to 6 months. The current deadline for applying for that is the 31st of March. And again, we may see that deadline's moved forward. Please don't rely on it at the moment. That's the deadline to work to. Repairs on properties can be carried out. Obviously, you need to keep properties in good repair for the tenants. Apart from if they're clinically extremely vulnerable. Now, obviously, we need to keep a balance of keeping the property in good repair and people's health. So there is guidance on .gov.uk for what you can and can't do. One of the most important things, and one of the most useful thing that your accountant can do is to make sure that your tax return is submitted. Because if are having difficulties making any payments, then the tax office won't enter into any negotiations unless your tax returns have been submitted. Once your tax returns have been submitted, allow us 2 days and then contact in the revenue. If your tax liability is less than £30,000, there's a facility now where you can log in and arrange a time to pay arrangement with the tax office. That doesn't mean to say that if your liability is more than £30,000, you can't still contact phone the number and make time to pay arrangements for your tax liability. You've probably heard about the self-employment income support scheme. Now, unfortunately, that's only really going to apply to where there's a genuine business, so, where you've got self-employed bed and breakfast owner or actually a hotel. Finally, recently, stamp duty or land transaction tax rates have been reduced temporarily. We're expecting rates to go back up on the 31st of March. Again, we'll be keeping a close eye on whether those rates will change on the 31st of March. So reduced rates for England and Northern Ireland and Scotland. Wales, you will pay a lower rate, but second properties won't experience quite as many savings. So it'll be interesting to see what happens in the property market in Wales. Okay, so this is just a reminder of where we've been really with tax relief on interest. So back as far as 2017, we could deduct all of the interest in our calculation. So if you're a higher rate taxpayer, you would get all of your tax relief deducted at 40%. Now, because the government didn't like that, what they wanted to do is move over to having tax relief just at the basic rate, so 20%. But rather than move over straight away, they did that over a phased period. And 2021, which is the tax year at the moment, is the first year where we've seen that all interest is only deductible at 20%. The same rules apply to interest as they do to the cost of retained finance. So if you've got any mortgage arrangement fees, then they'll receive the same treatment. I said at the outset we'd look at furnished holiday lettings. So there are some criteria that you need to meet. The first one is that if you do have any longer periods of let, where somebody's in the property for more than 31 days, then those total periods can't exceed more than 155 days. And it's probably a bit more clearer if I explain the other rules, which are that the property must be available for at least 210 days. Now, in terms of weeks, that's 30 weeks. It must be available to be let. Then it must be actually let for half of that period, so 15 weeks, 405 days. Now, obviously, for last year, there's going to be a lot of furnished holiday letting businesses which won't meet that criteria. We're keeping a very close eye on what the government are having to say about that. At the moment, they haven't changed their stance, but we will be the first to know if they do and if there's any more relaxations. But at the moment, what established landlords with furnished holiday lets can do is to ask their accountant to make an election. It's called a period of grace election. And what that means is that you can have 1 year, if you've had a previous qualifying business, you can have 1 year out of it and still qualify for your property as a furnished holiday let. And when we cover the pros of furnished holiday lets in the next slide, you'll see why that's important. So one of the differences is that your interest on your mortgages, we've just covered where mortgage interest relief has been restricted to 20%. Or if you run a furnished holiday let and you have a mortgage, then all of the interest can be deducted. So if you're a higher rate taxpayer, you will get 40% tax. You can also claim capital allowances on certain equipment that you use in the business, and you know, for example, cookers and things like that you put into the property. If you're thinking of making pension contributions, then your earnings will count towards allowance. Normal residential lets won't qualify as pension contributions. The other thing about first holiday lettings is that the profits can be shared depending on who is carrying out the work. So whereas a residential property, if it's owned 50-50, then the income will need to be reported on that basis. Where a holiday let is run, you might have a situation where one of the spouses carries out more of the work and you can allocate the income to them. The other advantage is that for capital gains tax purposes, for residential property, we see a maximum tax rate, capital gains tax rate of 28%, whereas this can be reduced to 10% at the moment for furnished holiday let properties. We're closely looking at the budget on the 3rd of March to see whether that changes. Rollover relief and gift relief are also useful reliefs. So if you own a residential property which you use as a holiday let and you sell it at a gain and then buy a new one, then you won't necessarily have to pay your capital gains tax there and then. The same with gift relief. If you gift away a holiday let, then you can defer the gains so that the recipient of the gift might have to pay the tax at some point in the future. Some of the cons of things against furnished holiday lettings are that there are normally higher agent fees. So if you aren't managing the property yourself, then you will probably incur higher fees. It's probably going to be much more time consuming, so you need to make sure that you've got enough time to deal with bookings and changeovers, or to arrange for people to do that for you. The income stream is obviously more variable. We've seen that from last year. Most holiday properties would have been, their turnover would have been reduced substantially. But as we move out of this lockdown, we may well see that as people are put off maybe going abroad, want to stay in this country for their holidays, there may be a massive bounce back for holiday lettings. One of the disadvantages is that holiday lettings is within the scope of VAT. So if your turnover is above a threshold of £85,000, then you'll need to register with VAT, but a lot of smaller businesses won't. However, you will need to take care if you're already a VAT registered business, because your VAT registration belongs to you, and anything you do potentially within the scope of VAT needs to have VAT added to it. We're now coming on to incorporation. As I said at the outset, this has been partly driven because of the loss of full tax relief on interest. Claire deals with a lot of these kinds of cases in practice. So I'm just going to hand over to her to go through this particular section.
Thanks, Gary. So yeah, as Gary said, this is a really popular query that we get as to the best structure from a tax perspective for holding residential properties, whether they're personally owned or whether they are owned within a company. There's lots of different things to consider from a tax perspective with the ownership structures. Most common is going to be the income tax and corporation tax positions, but also there's stamp duty and land tax to consider, as well as capital gains tax and inheritance tax. We can analyse the situation that you have and review whether there is anything that can be done to change the current structure or to make it more tax efficient, or if before you do any making purchases, whether you have an alternative structure set up to purchase properties. Now, we've prepared some simple examples to highlight the differences in total tax payable to revenue depending on the ownership. The first example we've got here is 2 residential properties held in the sole name of high rate taxpayer individual, rental income of £18,000 annually, and a mortgage with interest of £7,500. We base that on a rate of about 2.5% per annum. Each individual will have their own £1,000 property allowance. Now, this isn't on top of expenses. This is either or. So if your expenses are more than £1,000, you don't get to claim £1,000 and your expense. So we've based this individual's example on not having any other expenses, just having a property allowance of £1,000. With that in mind, a personal tax liability of around £5,300 will be payable annually for this client. Comparing that to the same properties held in a company, limited company, so we've still got the £18,000 annual rentals, it's likely that the mortgage interest is going to be higher for commercial mortgages, but that is something an IFA will be able to advise you on. On the basis that the individual, again, is a high rate taxpayer and draws all the profits after tax from the company via a dividend, and they've got no other dividends, then a corporation tax liability of around £1,710 will arise, with a personal tax liability being reduced to £1,719. So comparing the total amount payable to the revenue, both in corporation tax and income tax, we've got £3,420. There may be that, as we've seen, the increased cost of borrowing for a mortgage can be higher for a commercial property in a company. However, this is going to be dependent on what the mortgage rates are. The company will get full deduction for those interest rates, unlike the interest relief on for an individual only getting the basic rate relief, as Gary mentioned earlier.
Yeah. Obviously, corporate companies will only pay tax at 19%, so yes, you can get your tax relief corporation tax rates of 19%.
Yeah, rather than the 40% being a high rate tax. So that is obviously a significant difference, and that's where the initial sort of saving is seen. But where we're saving in tax, it might be an increase or that might be outweighed by the additional cost of borrowing, and potentially other costs might be incurred. But that's all going to be dependent on your situations.
Yeah, inevitably with a company, we can have more administration costs, more paperwork to do, so inevitably the administration costs will go up as well. And if you compare the £3,400 tax liability, add in the additional interest and also your additional accounting costs, you're probably not going to be that much better off. It's just worth pointing out that towards the end of these examples, we have summarised them in a bit of a useful table, so you need to make frantic notes at this stage. Let's move on.
So we've developed this example one step further to include the individual having a spouse who is also a shareholder director of the company. So we've got 2 shareholders, and we've changed the ownership or shareholdings to be split 25%, 75%. Now, this is to consider the spouse being a basic rate taxpayer, whereas we've got our original landlord as a high rate taxpayer. So again, the situation is the same. We've got annual rental of 18,000, deduction of mortgage interest at 9,000, and post profits are charged subject to corporation tax with a liability of 1,700. That stays the same. It doesn't matter how many owners we've got. The shareholders can both draw the dividends post-tax profits, and with both dividend allowances being available, that is to say each individual has £2,000 where there is no tax subject to tax dividends, that's at 1%. Making use of both of those, £2,000 for each shareholder, personal tax liability totals £260. Obviously, that is a considerable difference to the original £5,000 we saw in the first slide, with just the higher rate taxpayer having full ownership of. Total tax liability to £1,970. And again, we've just covered the fact that this also includes increased mortgage payments, but potentially additional accountancy and admin fees as well to consider.
Yeah, this is going to be very unique to your particular circumstances. So if you're already company directors or have a small share portfolio where you're using up your £2,000 dividend allowance, then the liability can be private. So we have to make a lot of assumptions. As we work through, you can see that there's even more assumptions. What we really need to do is to review your overall circumstances, which will be unique to you, and just have tax assist account will be able to help do that. Next.
So yeah, there's other things to consider with having properties in a company. If you already own property personally and you want to move them into a company, there are going to be tax charges for stamp duty, land tax, and corporation tax, moving properties from personal ownership into the company. These are based on the market value of the properties at the time, and this is something that we can help you with. As you are owning properties personally, these will be a deemed disposal, so it is really important that everything is looked at before any transfers are made. It's also worth considering how much earnings are required to repay the borrowings. Now, for a high rate taxpayer, you're going to need more post-tax profits to repay the capital element of the mortgages. For a company, it's going to be less, and that's due to the 40% versus 19%. So that's something to consider. Companies obviously don't have to pay out their post-tax profits. They can be kept in the company and build up reserves, and the capital could be repaid using those profits. So again, that's going to be unique to everyone's scenario, whether they need to draw those profits or whether they can use to start to draw down on the capital amount that's being borrowed. Again, as Gary mentioned, the scenarios that we've covered are assuming that there's no other dividends received, so the full nil rate band for dividends is available. Again, if you're already a director shareholder or you've got a share portfolio, that might not be available for this scenario. And also, it's really important when you're looking at an incorporation what your long-term plans are in terms of exiting the company eventually, whether it's something you want to sell the properties in the company and draw the capital in the future, or whether you're going to pass the shares on to future generations. Any disposals of residential properties in a company will be subject to corporation tax of 19%, but there will also be a tax on extracting those profits from the company. So you could end up in a situation where you're almost getting a double tax charge because the company's paying tax and then you as a shareholder director are paying tax for the profits from any disposal. So it's something to, again, consider and think about what your long-term plans are. So it's always important to have a business plan and be fully aware of what your long-term intentions are when considering this route.
The other point there was about the mortgage arrangement fees. From what we've seen in the market, arrangement fees for corporate mortgages are substantially higher than personal borrowings.
Yeah, and that's going to be dependent on what your deposits are and the situation. So yeah, it's worth getting.
So we can factor that into the calculations for you. It's incredibly complicated, and all those different factors need to be taken into account. Just moving on to spouse transfers then.
So where properties are owned personally, if you are married, there's the option to share the rental profits between you. This can be done by a legal election document which changes the default position of 50-50 to any ratio that is appropriate for your situation. Again, with our example from earlier, we've done some workings to show how the change in total tax payable to revenue can be affected by changing the ratio share, profit ratio, sharing ratio. The election is very strictly needs to be submitted within a set time frame, and your tax system is going to help you with that to ensure it's done correctly. So the examples we've got here, again, we've considered the same £18,000 rental, but we've changed the profit sharing ratio to 25%, 75% in favour of the basic rate taxpayer spouse. The same mortgage interest. Now, the basic rate taxpayer spouse will effectively get full deduction for their mortgage interest, as Gary explained earlier, with the high rate taxpayer only receiving 20%. The outcome of that, compared to our original one, is that total tax liability for both spouses is £2,450 for the year, and this obviously is significantly lower than just the higher rate taxpayer spouse owning the property personally, without sharing the profits. Something else to consider is, we mentioned earlier, the £1,000 property allowance for expenses. Both spouses will get £1,000. This isn't a per property, it is per owner. So if your expenses for the year are maybe only £800, you will still get two lots of 1,000 deducted into your share of the profit. So that is something to consider, and it does have an impact, which we'll see later on when we look more into the examples.
Yeah, and with the personal borrowing, I think that the interest rates will be slightly lower, and there will be, of course, accountancy costs. There will be accountancy costs, but there won't be any additional accountancy costs for having to run a company. So you can leave those factors out of the equation.
We've taken the example slightly further, where we've reduced the high rate taxpayers share to only 10% and the basic rate taxpayer 100. This is just to show that the election can be done to demonstrate any ratio, and this further reduces the overall tax liability to, again, £1,860. Conversely, if you go too far to the extreme, you actually end up being slightly worse off, and that is because you are losing out on the additional property allowance of £1,000. There is merit to having both spouses having an element of the ownership. Again, this is going to be very dependent on everyone's personal circumstances and what other income maybe each individual has. But this does demonstrate that you could go too far the other way and end up not getting it quite right.
Yeah, we need to look at what annual expenditure you would normally have. Are there ongoing costs which you have, which means you won't be claiming the property allowance? So everything needs to be factored into the calculations. It's incredibly complex, but we can provide a solution for you.
So as Gary promised, we've got a summary table which explores all the options that we've sort of considered here, going from the top left, which is an individual holding a high rate individual holding the property out of a company, paying 40% on all the profits, and going down the page to the different sharing ratios and the total tax payable to the revenue. We've got this sort of sweet spot in the middle of around 25-75 ratio for the company, with the shareholders drawing dividends and obviously the the company paying corporation tax. So again, this is going to really factor into what your circumstances are, and it is really important that we have a look at everything and take into account all aspects to see which is the most appropriate ownership split for you, and what structure it's best to hold the property in.
Yeah, I just want to make the point as well that we spend a lot of our time advising clients how they can extract money from their company, and effectively running a small landlord portfolio through a company. You know, you're putting assets into a company rather than trying to get them out. And at some point, you know, you're going to want to get either the benefit of the increase in the capital value or the profits out. So depending on how you plan to do that, will depend on what route you choose. Thanks, Claire. I just want to move on now to capital gains tax, and where we are following the major changes from the 6th of April 2020. So where you've previously lived in a property and then rented it out, maybe, when you come to sell that property, a few years ago, you could claim that the final 36 months also qualified as being your home. So that, you know, it's 3 years on a straight line basis of exemption, which you could claim. Now, a couple of years ago, that was reduced to 18 months, and from the 6th of April 2020, we saw that reduced to just 9 months. So that period really is to allow you to sell your property potentially whilst you bought another one, so to cover that overlap period. But it's moving into a smaller overlap period, apart from perhaps if the taxpayer is disabled, or if they're moving into care, then they have kept the final 36 months. There used to be something as well called letting relief. In fact, there still is. Now, where you'd both lived in the property at some point and let it out to somebody else, then there was also a letting exemption. Now, previously, you didn't have to live in the property at the same time as the tenants, but that's been changed now from 6th of April 2020. So you will only get what is quite a generous relief of up to £80,000. You will only actually get that now for periods where you spent time in the property at the same time as the tenants. Now, most landlords running a property portfolio won't be living in the property at the same time as the tenants. If you're doing that, you're probably into the rules for rental relief. Just moving on now to the more stringent rules for tax returns for the disposal of property, and I'm just going to hand over to Claire because I know she's dealt with a number of these.
Yeah, so previously any disposals of residential properties were dealt with on your annual tax returns. From April 2020, these were changed, the rules were changed, and a return has to be made for any disposal of residential property where within 30 days of the completion of the property sale. So that is also making a return and paying any tax over to the company within 30 days. Now, that's quite a short period of time compared to the potential 22 months, which you used to be able to have if you, say, sold a property just before the end of one tax year and it wasn't, the tax wasn't due until January the following year.
Yeah, sometimes it was difficult to come up with all the information that you needed to, prepare that return within the 22 months, and now we're down to 30 days to report the transactions from the report that you're down to know that we're planning to do this, so we can get everything in place.
Yeah, so obviously taking all the documents from the initial purchase as well as the sale. You'll need to you'll need to give your accountant access to your online property account to be able to submit these returns, for them to be able to submit them on behalf, and the consideration of the personal managers and annual exemption, which is very important to deduct for these. Now, non-resident landlords, this is for individuals who live overseas, they're not resident in the UK, they retain property in the UK. There's a special scheme for their non-resident landlords for income anyway, but for properties, if the non-resident disposes of the property, they too need to make these return within 30 days to revenue. Now, we've had a few of these offshore individuals who've made disposals, and the key here is to let us know as soon as you're thinking about making a disposal, because there is a lot more, it can be a lot more time consuming, and the rules regarding non-residents in terms of the valuations to use for the base costs is different to normal scenarios. Gary's got on the slide here that we've got looking at the valued at 6th of April 2015, and also for commercial property 6th of April 2019. Really important to have all the information. There's also things to consider like enhancement expenditure, any improvements you've made to the property, be it UK resident or non-UK resident. It's important to consider. But for non-UK resident, you can only get enhancement expenditure incurred after the 6th of April 15, not before with a deduction. So there's something to consider. And as Gary said, collating the information and speaking to your accountant at the earliest opportunity is always the most favourable, because there are penalties for the late submission of these returns, and as time goes on, they only get more expensive.
Thanks, Claire. It's worth also mentioning that we're not talking about just sales, but if it is a sale on the completion date rather than the exchange date, but a sale is also deemed to include a gift. So if you've given a property away, or by the same basis.
Yeah, and that actually comes back to when I said earlier about property going from personal ownership into a company. We mentioned earlier that there could be stamp duty, land tax, and capital gains tax. And again, even though there's not an actual sale, it can be a deemed disposal. So if it's a residential property, a 30-day return is required, and the tax, there will be tax due if there is again. So again, it's something to talk to your accountants about, because it could be something that you're not even aware is an actual sale, but is deemed a sale from the revenue.
The final point I wanted to make on capital gains tax is, and this is actually in favour of the taxpayer in most cases, where a property now changes hands between spouses, that's not a disposal of the capital gains tax. Well, it is, but that's deemed to occur at a no gain, no loss, so it's not actually a CGT charge. But in the past, there were cases where a property which had been a home transferred between one spouse and another, and the recipient spouse wouldn't necessarily inherit the CGT history from the spouse that was giving away the property. But that's much more generous now, so that's something in favour of the taxpayer. So if you have previously asked your accountant to do some calculations for you, and think that then you may have been penalised for that reason, it's probably worth revisiting with your accountant, just to have a look at that advice again, because it would have changed. So that's definitely worth considering. I just want to move on briefly now to making tax digital. 2023 seems to me a date which is far off in the future, but it's soon going to come around. And some landlords might want to start moving towards digitalisation of their records before then. We can provide you cost-effective solutions for the software. You're going to be required to complete these, retain these digital records. Our advice really is, if you don't have an agent ready, to appoint one to advise on what software to use. There's going to be more of an administrative burden, because you're going to have to send in property rental accounts, unless they're very small, 4 times a year, in fact 5 times a year. So you have to do 4 quarterly returns and a final return. So we see this as not making things simpler, but making things more complicated for you. Your time is precious, and this is something we can really help you with. So the best thing to do is contact an accountant in the run up to this deadline, because we really do think that most people will need one. Okay, so just a bit of a recap really before we take some questions. The main things that we help with is keeping up to date with coronavirus changes. So any client of tax assist will receive regular updates, at least weekly. As things come out, you'll probably get more frequent updates than that. So you'll know as soon as there are any changes. If there's any announcements of grants available to you, then you will know as soon as that's available. We can help you decide what the best structure is for your investment. There's often a lot of grey areas between capital and revenue expenses. So those expenses which you can set off against your rental income versus those that will eventually be allowable for capital gains tax purposes. So we can help you allocate those correctly, hopefully without any challenge from the tax office, although generally we do successfully defend what we've done. You know that we'll keep a record of that on file until it's required. We can deal with all your compliance, including capital gains tax. Claire just covered those points about returns required within 30 days. We're really ready to hit the ground running with those. So please let us know as soon as you're thinking of selling a property. MTD, we see us playing a massive role in helping for that to be successful. Most importantly, though, just advising what you need to pay to the tax office and when you need to pay it. Nobody wants to pay interest or penalty. They can avoid that. What we're also looking to do is really expand how we can help you plan for the future. So, what might immediately save you some income tax may not be the best thing for the future. So we're trying to pull in all those different areas and build that up into one big plan, which is suitable and tailored for you. Okay, questions. I think you were looking at questions that came through.
Yeah, I've got some. So we've got when I fill in my tax return, I ask if I want to use traditional accounting rather than cash based.
Okay, so a while back, all landlords were required to use traditional basis of accounting. So at the end of the year, they'd have to look at what rent they owed, take that into account, and also be able to deduct any expenses which they've received invoices for but haven't paid. But that's now moved over to a default position where if your rental income is less than £150,000, you can simplify things and use the cash basis. You're only taxed on the rent you receive. You only receive tax relief on the expenses you pay. Now, obviously, you've got any invoices received towards the end of the year, you're best to pay those and get tax relief. So that's really the main difference with that. There has been a change in recent years. The default position has changed, so just be careful with that.
Next one is, will I have to pay IHT inheritance tax on my holiday property if anything happens to?
Okay, that's a complicated one.
So, well, the short answer is no, you won't, but the family might have to consider whether the holiday property qualifies for business property relief. This has been covered a lot recently with various cases gone to tribunal with different outcomes. And the main factor is how significant the services provided by the furnished holiday letting owner have been. So you've got different, you might have a holiday let which is managed and run by an agent and you personally don't really have much to do with it. That's one end of the spectrum where you probably won't get business property relief. So you will get charged 40% of tax, depending on your scenario, on that at death. However, if it's a holiday cottage that you take the bookings for, you provide additional services such as organising games nights, and you provide food shopping for the food shopping service, as well as other sort of services to make it more of a business and you're spending more time, that could be at the other end of the spectrum, and it is more of a business, and therefore the relief may be available. So again, it's not as clean cut as yes or no, so it's going to be dependent on your situation and how much of a business you actually are, you have for that holiday.
Yeah, I think I'm probably right in saying that, with the cases, there's been 3 or 4 recently, tax cases. Some have gone in favour of the taxpayer, some have gone in favour of the tax office. We really need to compare your circumstances with those cases. There's very little guidance on it. It's mainly governed by case law, so that's what we have to do. But generally, you need to be running it more as a business rather than being just a land. You need to be more than property land.
And that is something that, again, we can look at. We've got a furnished holiday let, and you want to be prudent for the future when it's being passed on at your death. Then it's something that we can look at to help you sort of manage whether you want your future generations to incur a tax charge. So you've got that knowledge, or whether it will be covered by the relief. So there's a lot around that. Next question relates to mortgages. I borrowed more on my home mortgage to put a deposit down on my buy-to-let. Can I claim the interest from my home mortgage?
So this is a scenario where somebody might added to their home mortgage
for the deposit as well as having
well, there is some good news there, actually, because the tax office, they operate a purpose test. So if you've borrowed money on your private mortgage to fund a deposit on a buy-to-let, then you will be able to claim the interest on that element of your private mortgage as well as the buy-to-let mortgage. You need to keep a very clear paper trail of how you allocate those funds, so that that paper trail isn't really diluted by your personal expenditure. So you'd want to see that the deposit was paid swiftly after you receive the advance on your home mortgage. But that is possible, and something we can help you with. The calculations, in particular, where you've got an existing mortgage, can be more complicated. So we can help you with that. If you've got no mortgage, then the calculations might be a bit easier. But
refurbishment costs. When we bought our buy-to-let, it was very run down, and we paid quite a bit less for it as a result. Can I claim all of the refurbishment costs against my first renting?
Unfortunately, the tax office operates in rules where if you have acquired a property, in a rundown state, and the price of that property does reflect that. But that is the case, then generally the expenses to bring that up to scratch to rent out won't be allowable against your rental income. However, what we can do is keep a clear record of those ready for when you sell the property, because that's when that tax relief will be available for capital gains tax purposes. So it's important. There will be some costs which you can claim. What we can do is go through that list with you, decide what is deductible for income tax purposes, what can be saved to claim against CDT in the future. So
I think we might wrap up there if that's okay. Just conscious of time, and I think we could go on indefinitely, really, because there's a lot of questions still coming in. So thank you all for watching, and thank you for putting those questions forward. What we'll do, as we run out of time, is we will try and get back to each and every one of you with an answer to those questions. So please do look out for those. If you come up with questions after the event, then please do get in touch. There's some contact details on the screen. And obviously, some of you will be tax assist clients, and you can contact your local accountant. The other thing you can do is we will be putting a recording of this session onto our website. Again, details on the screen, and that will include our slides as well. A lot of information there, so do have a look at that if you need to, just to recap on what we've been talking about. So I'll wrap up by saying thank you to both Claire and to Gary. Not easy producing these types of events. There's a lot of technical content there, as you would have seen. So thank you both for going through it, and well done for braving the sound of a helicopter in the background in the last session. Who'd have thought that we'd have to battle with helicopter noise, but there you go. Hopefully there was a lot of useful content there for you. Couple of takeaway points from me, I think. Do stay in touch. We are living in changing times. There's a lot happening. And I think both Claire and Gary have talked about some changes that are happening, have happened. And I think we'll see more changes in the years to come. So do stay in touch, look at our website, stay in touch with your local accountant, and it's our job to keep you up to date and informed where we can. The other point that was very, very clear is that sometimes there are just not simple answers. We've tried to give you an outline of some of the things to think about, but as I think both Claire and Gary have said, it often boils down to personal circumstances, and that's where there's real value in good quality advice, because it is about getting something that's right for you rather than trying to find a one-size-fits-all solution. So please do talk to us, and we'll try and help talk you through what may work for you, your family, your business. So that's it for us. We are open for business. If you do want to talk to us further, you can meet online with one of our local accountants if you're not already a Taxis client. We offer free telephone and video consultations. We'd be happy to talk to you. As I say, do stay in touch. Our website includes a number of things, including a landlord hub. There's a fair bit of information on there, and both Claire and Gary are updating that regularly just to make sure we keep it current. But we hope this content has been helpful. Please do look out for future events. We're running these webinars on lots of different topics all the time. But thank you very much for watching. Do stay safe, and we hope to see you soon. Thank you.